Hey, what's up, Market Moose? Mike from the Moose on the Loose. I am super excited about today's show because I am reviewing one of my DSR members' portfolio. He asked some interesting questions. I thought a lot of you guys probably asked the same ones. So let's dive into it right away. All right, so we're gonna call him William. William is at the end of his 30s, married to a beautiful wife, 2 daughters, business owners as well. So I can connect with this guy definitely. He's a bit younger than me, but anyways. And he has this portfolio, building it right now, actually adding capital every month to it. He has currently 15 position, wants to grow to 20, has roughly 50% Canadian, 50% US stock split. So well diversified, all invested in stocks, kind of interesting. So then he sent me his lineup. They're about equally weighted, so I'm not going to talk about the numbers, but just imagine that all those stocks have about the same weight. So we have Lockheed Martin, LMT, a play on defense on the US side. Then in the financial sector, we have Royal Bank on the Canadian side, and then Visa, a payment processor, on the other. So definitely an interesting mix here. Stella Jones on another one of my holding, actually. I do not hold Lockheed Martin, but I hold Royal Bank, Visa, and Stella Jones. A play on, I would say, almost like utility businesses, because most of their sales are coming from selling utility poles and railway ties. So we're thinking like a bit of industrial, a bit of a utility play, but Stella Jones operates into the basic material sector. We have Toromont Industry, definitely a play on infrastructure, industrial company, leasing and selling equipment. So and again, another like great performer actually this year, and we're going to talk about it. We're going to do a deep dive, Nelson and I, tomorrow, so you don't want to miss that episode. So pause, subscribe to the channel, and then go back to it. Then we have some AI/technology plays with Apple, Microsoft, and Meta. Meta is in the communication sector, but let's be honest, it's all about AI and it's all about technology. And then we have some consumer stocks, Alimentation Couche-Tard, Pepsi, Metro. So again, great variety. And then we go to his main question. The last 4 stocks are not exactly aligned with those. And what I mean by that is if you look at Lockheed Martin, Royal Bank, Visa, and so on, they're all about strong growth, right? They are solid companies. They've been around for a while. They are increasing their dividend for a while, but none of them could be classified as a high yielder, for example. Or another thing that I like to call my like boring stocks is deluxe bond. A deluxe bond is like a bond proxy. It's a stock that you don't expect much in terms of capital appreciation. So you don't expect this company to drive your portfolio total return, but it's very stable. It pays a good dividend, usually a higher yield, but keeps on increasing the dividend. So it's a little bit better than a bond in terms of total return, but has almost the same characteristic or usage in same role into your portfolio. So here's come is 4 deluxe bonds, as he called them. So you have Brookfield Renewable, well-diversified utility play on the renewable energy. You have Canadian Natural Resources, another one paying a high yield but very stable, sitting on super high-quality assets and just increasing the production when the oil price and natural gas price goes up. So a great way to boost cash flow during those bull time. You have Fortis, great utility, the mother of dividend growth in Canada with more than 50 consecutive years with a dividend increase. That means that this company has gone through everything, all the crisis possible and impossible, and still found a way to increase its dividend. And finally, Granite, as I like to call it, a very frustrating holding because the REIT shows great numbers, but the performance is pretty much meh. This year is having a great year, but it's pretty much about time because definitely lagged the market over the past 5 years. So here's come the big question from William. So he's looking at his portfolio and he's like, yeah, I have some exposure to deluxe bonds, but I like to call myself a growth investor. And then he's like, am I playing myself, telling me stories about the fact that I'm a growth investor, but I'm not really a growth investor because I have those four companies? And if you think about that, it's almost a third of his portfolio at this stage. So is it like a bad thing or not? And if you look at them, you could even almost include Pepsi. So you're almost at one third Deluxe bonds. So is this wrong? Am I really a dividend growth? Am I really a growth investor? Where do I go from there? So I got three thoughts on this. The first one, labeling. I know it's a lot easier to think about, oh, you're a growth investor, you're a passive income investor, you're a momentum investor, you're a value investor. But really, if you go down to the root of each strategy, you're going to realize that most investors are hybrid investors, right? You do a little bit of this, a little bit of that. And then when it comes down to labeling, it could get a lot confusing actually if you just select one label. For example, I see a lot of people on Blossom, for example, calling themselves passive income investor because they focus on the income, which is really fine. I'm not saying it's bad or it's good. But ironically, those passive investors are usually trading every month and then sometimes more than once a month. So is it that passive? I don't know. I mean, again, not saying that it's a good thing or a bad thing. It's a good thing to be a hold on your stuff. But just when you go deep dive into the label, you see that there are some cracks, right? Same thing with me. I mean, I qualify myself as a dividend growth investor, but I do have those actually four Deluxe bonds, Brookfield, Canadian Natural Resources, Fortis, and Granite. I have them in my portfolio. I do have a few companies that are not growing their dividend, like Constellation Software. Do not worry, guys. I haven't forgotten about you. I'm going to do a full episode on Constellation Software, but just next week. So I have Amazon in my portfolio as well. So a few of my my stocks are not paying a dividend. So am I really a dividend investor? Am I really a dividend growth investor? I don't really care, because what's really important, and that's my second thought about this, is forget about the label. Focus on the process. What is your investment process? Is it clear? Do you have like investment rules? Are you focusing on specific metrics or characteristics to make sense? If I write down my investment strategy in simple terms, I would say I'm a dividend growth investor. So I focus on companies that has this ability to grow their dividend. And that is true for more than 90% of my portfolio. So if my strategy covers more than 90% of my portfolio, I'm fully aligned. I'm making some sense with myself, and I don't have to label myself with like one word or two words. That doesn't mean much anyway, right? And I do have those Deluxe bonds. And that comes with my third observation on that is, why having Deluxe bonds? Even like in any cases. Well, I'm going to tell you about myself because I cannot tell about anybody else. On my side, what I like about the Deluxe bonds is they pay a good dividend. So that makes me smile. Even though I'm yield agnostic, it's always fun to receive money. I'm human. I have emotion too. So definitely receiving those juicy dividends is always fun. Even though it hurts a little bit the total return, what I like about it is the fact that I'm always 100% invested. And being 100% invested comes with a lot of pros and cons. And one of the major disadvantage is definitely to be having a portfolio that has a higher volatility. And when it goes down and there's a big bear market, well, I'm taking a huge hit. So having those dividend coming in is a reminder that everything is fine. It's a reminder that it's like a bond. It's paying me something to add a little bit more stability and give me some of my money back so I can reinvest it somewhere else. So it's a feel-good type of stock. Those companies, usually I'm comfortable enough to put them into a black box, forget about them for 10 years, and I'm still happy. So those are the reason why I have Deluxe bond in my portfolio. At a very young age, I made the decision to be 100% invested all the time, but I also wanted to have some companies that would act like bonds in my portfolio, meaning that they are not going to grow that fast, but they're going to pay a good yield and they're going to increase it to make sure that the distributions will match or beat inflation. So in the end, what really matters is to be able to write down your investment strategy in a very simple way and to follow your investment rules. Forget about the labels, focus on the process, and you're going to be happier and probably a more profitable investor. All right, Moose, that's enough for today. Do not forget to subscribe to my newsletter at moosemarkets.com/newsletter to not miss any shows, not miss any YouTube, not miss any newsletters, and all the other stuff that I produce. moosemarkets.com/newsletter. We're going to talk again tomorrow. We're talking about Toromon that is up more than 30%, and it's only the beginning. All right, Moose, stay good care. And in the meantime, don't forget to stay invested.